once the capital has been collected, then there is what we would call a period of investment for the fund. And this is the part which can vary. The level of specialization can vary, but it's very unusual that you would find a fund manager would invest in all industries globally.
Hi, everyone, and welcome back to TheCapitalNet TV. I'm Apoorva, and today with TheCapitalNet TV, we bring to you a very intensive and a very indulgent series which is revolving around the private market. Today, we have with us an industry expert, Mr. Cyril Demaria, who essentially is going to break down the private markets for you. Now, Cyril, we'll probably tap into your, sort of your expertise and the amount of years that you've spent in the private markets now. So what have you seen as the best performing asset class in probably the last 2 decades?
I think it's fairly easy to answer this one because you just have to observe where the investors voted with their feet. So where did they put most of the capital? Right. And it appeared that actually leverage buyout was very popular. Leverage buyout is popular because for investors, for example, it creates less anxiety. These are streams of cash flows, positive cash flows, basically, if we reduce it down to it. So there is a product and a service, there is a management, there are clients, there are products. So technology is there as well, if there is any technology. There is probably a defensible market position. And the idea was to make these assets more efficient or to transform them so that they're having a greater future, basically. And on top of that, you can boost the performance by borrowing a cheap resource, because when you do a leverage buyout, you acquire a company, but you borrow some of the money to do this acquisition. And the money that you borrow is fairly cheap compared to the yield generated by the asset itself. So this was, in a way, the perfect investment strategy in terms of risk return for a lot of investors who are a little bit more conservative with risk, and they want to understand better. If you invest in startup, it's very exciting. Yes, of course, everybody loves it. I think, at least intellectually, it's a nice challenge. But if you manage money for others, as pension funds do, or insurance group do, they get a little bit more nervous and uneasy because for them, it's difficult to understand, if it's going to be successful or not. There might be cycles. So venture can perform very, very well, or not very well at all. Yeah. And so it's a bit of a roller coaster, to use a very old image. But buyout is a little bit less affected by that. There are some cycles, obviously, but it's a little bit more predictable. And what we know, for example, is that on aggregate, at any given year, the buyout funds never lost money. So if you could buy the market, you will never have lost money. There was no time where it went below a multiple of 1 time your money. And so for pension fund and insurance groups, then that reduces some of the risk there. You still have to select the funds you want to invest in, and that's a risk. It's a significant one. But compared to venture, for example, where, as I said, it's a bit more of a roller coaster, there were some vintage years where, unfortunately, you wouldn't have done very, very well, even if you could buy the market. So buyout was one, to answer your question. Second was private real estate, definitely, because real estate is a big portion of allocation of assets. And sometimes the traditional universe, which might be listed or direct real estate, has been a little bit saturated. So you have allocated as much as you could in a reasonable environment with your risk return approach. And concentration is one of the risks in a portfolio. So if you want to go out, then you need to go in a private real estate fund, and maybe they will give you an exposure to another geographical area or an exposure to a different type of strategy, which is less core, as I said, a little bit more transformative. So these are the 2 main areas which have been very popular. And besides that, then we started to see that direct lending has been also very popular, but that's also driven by the fact that fixed income has been delivering very low yields over the course of the last, I would say, 10, 12 years, something like this. And so this pocket has been growing very fast, for example, and has been very popular.
Correct. And now directly from that question also, Cyril, I would want to also ask you, now, how do you actually track this performance? Like, what are the key indices, like, in order to know which asset class is performing how? Was that, sort of conclusion drawn?
That's the part where probably there is a clash of cultures, I would call it like this. Fund investors come from a world which is, in a way, very simple. You can measure the performance through the increase of the value of an asset. So if you look at an index of listed stocks, then you take it at a given date, 1st of January, and then you see the progression until the end of the year, 31st of December. Now you have your framework, which is annual, and then you can measure the growth, right, including dividends potentially. And then you can see how it fluctuates over this period of time. Here you go. You have your risk, you have your return. In the private world, it's a little bit more challenging. First of all, because the annual framework for us, as we said earlier, is not really the reference anymore. And since we don't deal with listed assets, the value of the asset doesn't fluctuate. Actually, most of the time, when you get information, it's on a quarterly report. Sometimes it can even be on a semi-annual frequency. So it means that the values don't change that much. And when they do, it's very smooth because the fund manager tries to take the information into account, but it doesn't mean that you're forced to reflect, a massive increase or a massive decrease, even though today, for example, we're supposed to mark to market the portfolios of the fund. So compare them with what happens on the stock exchange. It's still very, let's say, smooth in a way. So what does it mean? It means that we have our own metrics of performance and also of risk. And that's a little bit where it's very difficult to establish a bridge. So we have actually 3 measures of performance. One is called the internal rate of return. The internal rate of return is probably the one which is the most used because it's something which talks to a lot of us, but it's a little bit tricky to use because it's a reconstruction. Earlier, I said on the stock exchange, you will look what happens over a year, and the internal rate of return annualizes the performance of an investment. So if you invest over, let's say, 3 years, 2 months, 1 day, then you look at the entry point and the exit point, and you say, if I had made this investment and on an annual basis, how much performance would I have generated? The temptation is then to compare this IRR with the evolution of a stock exchange index. But the thing is that they are not exactly comparable because one is really an annual exposure and the other one is a reconstruction. The IRR has a lot of drawbacks. So we never try to interpret it alone. We always combine it with another analysis, which is more cash on cash. And it's called the multiple of invested capital. The multiple of invested capital takes whatever you got back or which is estimated to come back in your pocket and is divided by whatever you put on the table initially. Okay, so it's nice, but actually, if you talk to the people from the listed world, they're a little bit puzzled because the concept of multiple of invested capital is not really what they use. And then a little bit more recently, there was a third metric, which has been developed and used. It's called the public market equivalent. The public market equivalent is a bit challenging to use. Sometimes it requires a little bit of work, but it's one of the few bridges between the traditional world and the private market. The public market equivalent says, what we're going to tell you is what you would have done in terms of performance if you invested your money with the same cash flow patterns than when you invested in the private world. So whenever you do an investment, we buy a portion of index virtually, and then when you sell it, we sell a portion of the index. And then we compare how much money would you have made with the index and how much did you make with your asset or your fund on the private world. So that's one of the few bridges. None of this method is perfect, unfortunately. And these are all sources of information. but you need to combine them and apply a fair amount of effort behind that so that you can, let's say, draw a conclusion. And of course, we didn't talk about risk, but there are different metrics of risk because the volatility, again, doesn't apply.